Maneesh Dangi joins us now. I always look forward to our engaging conversations, and every time off the record when I meet him, I like to call him the Guruji of macro world. So Guruji's come back from a short travel, right?
That's true, Nikunj. Hi, good morning.
So what is your view of the world? I mean, Fed has changed the view of US economy. Who would have thought at the beginning of the year, when we were discussing and debating soft landing, shallow recession, Fed will come out in middle of the year, they will upgrade their GDP outlook. What are the implications of that for all of us?
I think it's a bit of a noise there, but in general, we're nearing an end of a rate hike game, Nikunj. Perhaps it's the last lap, not just in US, but pretty much across the world. US economy, we've argued about it many times that it's holding up well, but that does not equate with buoyant growth. It's a decent growth, slowing, and in an ecosystem where countries like Europe, both France, Germany are contracting likely now. China is into structural struggle. So the general setup is that global growth continues to slow. It has surprised many strategists and fund managers that the growth hasn't slowed as much as they anticipated a year ago. But then it still means that at some point in time in the next 3-6 months, they're going to be decent pain given what the central bankers have done. So I continue to believe that Fed is likely done now. And the only difference between likely done with vis-a-vis the general reflex that we tended to have in the past is that a little bit of a soft patch and our Fed would actually chop rates. That's not likely to happen, and which is what is unnerving market to a certain extent, both bonds and equities.
Okay. The other big announcement which came on Friday, which will have deep ramifications, would be India's inclusion by JP Morgan. What implications would that be? I mean, we celebrated the inclusion on Friday in financial markets, calling it like an early Diwali and something which will have transformational changes. Is it true in your understanding?
No, I don't agree with that. It's basically a currency hedge that RBI has bought for two reasons. One, of course, Nikunj, is that the traditional sources of capital flows in India have actually been drying up. If you observe the facts keenly instead of narrative, the ECB has stopped trickling in the manner it used to. FI debt for last 6 years, there's been a winter there and money hasn't come on its own. FI equities, of course, notwithstanding the good time we've had over the last few months, 6-8 months, as a matter of fact, over the last 7-8 years, it isn't a durable money anymore. So in that setup, even things like FDI, again, contrary to popular narratives, is not as meaningful as it could be, and it's not rising anymore. Again, because of the global setups, we've discussed about these things many times. But then our need for dollar has been rising every year. We need $60-70 billion to fund our current account deficit. So as traditional means dry up, you ought to look for something. Otherwise, you end up doing things like FCNR and stuff like that in every crisis. So it's a good way. There was an orthodoxy in Delhi and in RBI that we should not expose our bond markets to the outside world. But if you need dollars, you ought to do something. So in some sense, it's buying of a little bit of insurance. Its impact on currency volatility would be less, but then impact on rates and equity markets is minimal or negligible. Especially for rates, I've argued about it many times that it simply displaces more programmable, more authentic, and counter-cyclical source of money like OMOs by a relatively more volatile and speculative money of sort of FI and stuff like that. So to that extent, it may end up making markets more volatile, and on net rate move basis is not substantial, Nikunj. So that's the way I look at it. But it's a welcome move. It's been something that has bond market practitioners, we've been waiting for at least 10 years. So I think it's a good idea to expose our markets, and to enrich market. What has happened in equity over the last 25 years, perhaps if we open it up to the rest of the world, there is going to be more volatility, good news for many traders, and therefore, it exactly a thing that, all bond market veterans have been wanting, but then its net effect is not as much as, as being sort of argued about in media.
What about equity investors, though, Maneesh? How should they be building the blocks right now? Because while the equity markets on an index level sure are off about 2.5%, 3% from the recent peak, we're not that cheap either.
So on equities, Aisha, the building blocks are, of course, very simply put, rate architecture and growth outcome. And on rates, as I've argued, that it is very likely that, we are coming to the top of interest rates. But unfortunately, even if there is significant disinflation, the real rate it would actually continue to stay up. And to that extent, the struggle on the rate front could actually continue. But it's not going to worsen in any significant manner from here on. On valuations, pretty much across the world, equity markets are saying that either we are starting with a new business cycle right now because there is anticipation of significant earnings growth pretty much across the world, even now, or they're saying that bond markets are completely wrong and Fed would and RBI would and many other countries would actually ease very, very sharply in 2024-25, which bond markets are not agreeing with. So the equity macro is in contrast to what currency macro and what do you call it, rates macro is, and to that extent, it's not going to be an easy deal. Valuations, of course, continue to remain expensive. In fact, in US also, we argued about 1.5 months back on your channel that there's no great play in US as well because especially tech has become pretty expensive in the setup that we live in. So on average, if I were to think of India, Aisha, then large caps have become expensive, have become cheaper relative to small and mid caps, which are in manic mode right now. And India is no more expensive relative to US. So purely relative investors, you could continue with large cap. But if you're looking for a risk premium relative to bonds, the problem is that if you pay 10, 15, 20% excess valuation, Aisha, then 3-4 years the excess returns over bonds don't come, and that's what has happened in last 2 years. Despite such strong flows, actually the risk premiums or excess returns over bonds haven't arrived for investors because you paid into mid 2021 or end 2021 higher than what you should have paid. Unfortunately, that ill has not gotten away yet.
Maneesh, morning. What is the outlook when it comes to the overall earnings growth? Because the expectation is that it could be at about 10% equal to what we've seen in the last 10 years versus 15%, which is what we've witnessed in the last 5.
Yeah. So our argument has been same that, the nominal GDP and earning growth have diverged over the last 5 years. They typically converge over a long period, as it happened in last 10 years. I am more of the view that over the next 5-10 years, the earning growth would be more like 10%, and markets are baking in, I think, faster. At least for next 2 years, the market's anticipating about 15% growth. I think as of right now, not many downgrades have happened in India yet, but I think that for the given macro where crude is, where general growth buoyancy, which is starting to peter down, my sense is that there is a decent chance of earning downgrade. So, and it's very, very unlikely that nominal growth would be any more than 10% over next 2 years. So, sort of expectation is a little bit of a wrong footing. Of course, we've had great 2020. Last 2 years have been really great, especially 2022 was great. And to that extent, it may have put in some bias, but my sense is that there is the expectation of 15% CAGR over the next 2-3 years is a bit of a stretch. It's going to be more like 10-12%.
So, Maneesh, for the short term, what is a good trade, which is 3 to 6 months? 1 year plays, what is a good trade? And for 3 year plus, what is a good trade now?
Okay, so I don't think it sort of suits most audience of yours. I think that because the stuff that I do, not many would do. But I think the cheapest asset in the world today is US dollar cash. It's earning you 5.5%, and it has great momentum to it, and it will preserve and protect you from any ill world economy. If economies spew flows reverse, dollar would actually continue to do well. So I think it's a good place. It's a bit of a like 2022 setup, and that's where you must hide. If from a speculator, I think for medium term, which is 1 to 2 years, I think you're going to make a lot of money in buying long US treasuries, which are at absolutely phenomenal level. I don't agree with high for long. It is true that for reshoring and many other reasons, including crude, interest rates will not go back to zero, but then does not mean that the cycle will not turn. And these rates are high enough for us as speculators to dial and actually hope for good 2%, 2.5% rally from here. So I think from a speculator point of view, for 1 2 years, there is a merit in actually buying into long bonds. Not Indian bonds yet, because India has a little bit of other complexity. The local reasons, Nikunj, of inflation have returned, and therefore we must wait for long India bonds. But US bonds look attractive at this point in time.
You invest and the way you allocate capital, how much importance would you give to election cycles? There are state election cycles followed by central election cycle, and everything will happen in next 12 months, less than 12 months actually.
So, in election primarily have two implications. One on inflation and other is risk appetite. I don't think governments in India matter much in terms of growth, and I think the general impact of government is overrated on growth prospects. But on inflation, there are clear ideological differences between two sides. And two sides is not necessarily two political parties. It's generally to do with how general household is experiencing or behaving right now. It increasingly is apparent, Nikunj, that every political party is now out there to distribute cash and largesse, essentially because the median household in India is in pain right now. So it's a political response to an economic problem that India or Indian consumer faces. That has implications on inflation. If you see poll-bound states, think of Rajasthan, inflation there at 10%. I would say that as nation gets into this, election mode, more and more such distribution, cash transfers, and many such things would be announced or executed. And that would mean that at least in near term, for 6-12 months, you'll have issues with respect to inflation. That's the inflation part. Second is on the flows. I think if there were to be 1 in 4 chance, which I assign that it is, that there is a change of guard in India in 2024, it is likely that the thing that markets rejoice a lot, which is corporate tax cut, or in general, things like PLI, which are quite suitable to large corporate, there is a risk to all of these. I'm not very sure whether they'll be reversed, because India policy reversals do not happen. Reversals don't happen as much. But then one ought to be careful. Fiscal is super tight, and if you have to fund a lot of these announced schemes, which are happening in states and they are struggling with it, I think it is likely that corporate tax cuts have some risk. Not necessarily in terms of pure reversal, but there will be more cess and stuff like that, which firms don't like and won't like. So I think that flows would begin to anticipate at some point in time, and will begin to dry up both local as well as more importantly global flows.
Right. Manish, always a pleasure to have you in DT Now. Thank you for joining us, and so nice to discuss the whole host of macro and micros in terms of understanding.